Hey everybody, Marty Mazur here. It's Thursday, the 21st of November, 2024. This is a day early, but this is your weekly video update. We won't talk about the score of our economic index because we're going to wait till after tomorrow's consumer sentiment survey results to score it. The reason I'm doing the video today is because of this. My schedule tomorrow and over the weekend is going to make it tough to sit down and bring you something significant or something meaningful, but I can do it right now. So let's just jump to some of the notes that are kind of notes to self or notes to staff here internally that I think are worth talking about here. Some of it showed up on the written blog a day or two ago, and then I'll get to some charts for you. Want to keep it pertinent and actually pretty quick today, believe it or not. So to start out, you can see I just put this note in about Nvidia, and my comment here is that with Nvidia out of the way, the year-end rally is ready to commence. Had a pretty good rally today, pretty much across the board before it was all over. Started the day actually weaker and ended the day stronger. There were a few events and headlines that I think helped out. There's one caveat to this year-end rally, in my view, and that's the December Fed meeting. If they don't cut by 25 basis points the Fed funds rate, my guess the market will react. Right now, futures are pricing in just roughly a 50-50, say 55% chance. So that's a risk for the market. What I've noted here is that whenever a Fed officer or governor steps in and says, hey, we're not going to need to be as aggressive as we were, market really sells off on that news. I think the 25 basis point cut is still pretty likely, but less likely than it was here even a couple of weeks ago. Another side note relative to Nvidia, while the outlook remains quite strong, particularly if you listen to their CEO, and I can't say that the significant downside that, yes, I ultimately see in its shares is remotely imminent, I will say that the 40 to 50% concentration of its business in 3 customers should have anybody, even the most raging bulls, and there are a ton of them on this stock, at least concerned or at least talking about it. Now, I say unnamed, but obviously it's Tesla, Alphabet, and Microsoft. Why should you be concerned? Well, number one, that by itself, there's just 3 of their customers that are the lion's share of their business. The other thing is that all 3 of them are actively developing new chips. And here's an article about Tesla really spending some money, according to Taiwan Semiconductor, and they make, by the way, I think all of Nvidia's chips, and they're working with Tesla right now. So Tesla has a platform using Nvidia chips. Their next phase or their next iteration is ideally to them is going to be using their own chips. So that's business Nvidia is not going to get. So despite the hoopla and despite the very promising commentary, and I think it's legit for a while, I think it's problematic at some point, their lack of moat, in my candid view. This next note here, Macro Research Board, MRB Partners, source of ours. You have to pay for their research. They do a really good job, and I respect their outlook. Here, my note to us here is I very much sympathize with their global fixed income outlook long term. Makes good fundamental sense to me. However, I'm not as sanguine as they are on the near-term global macro outlook. Thus, I personally actually see rates at some point in the course of 2025 seeing a notable downturn, making duration, long-term, interest rate bets, if you will, important to own going forward while rates come down, and then something to lighten up on during the recession before it bottoms, because when it looks like it's about to bottom, rates are going to start going up and bonds are going to start taking a hit at that time, while they will rally significantly during a recession if we're talking the equity market. Even in a mild recessionary scenario, next year's earnings projections the next 2 years make almost no sense, even in a soft landing scenario, in my humble opinion. But as I said the other day, that doesn't mean they're not going to go higher. This is what's called multiple expansion, as in the PE multiple, or let's just put it simply, the price has run off, right, and left the earnings behind. In 2016 and through 2019, stocks were trading at price to earnings multiples, 19 or below. Today, they're trading 30% higher. So they are trading at a 30% premium relative to if it just kept pace with corporate earnings. So a lot of Goldilocks, a lot of optimism is priced into stock. So just reason to continue to be on our toes. And that's why we hedge, and that's why we can take exposure and make money in a market like this, but protecting against something severe to the downside. Now, let's say folks like MRB are correct, and next year actually is going to be pretty good. Well, another headwind for rates is a very lofty present level of U.S. equities, like I've been talking about, right? Ironically, if they have it right, then if they get it right and there's no recession next year, in my view, the higher yields will likely sow the seeds of a U.S. equity market sell-off. We've noticed that, right? When suddenly it was clear that new policies and Fed policy is going to actually be stimulative, stock market hasn't really liked that, save for a day like today where yields went up and stocks went up at the same time. But equity market sell-off, if we get it, by itself will sow the seeds of a bond market rally, meaning bond prices go up and interest rates go down, while potentially, in a reflexive fashion, sowing the seeds of a mild recession, as equities presently occupy a historic percent of household net worth. One example of reflexivity would be the stock market actually leads the economy, not the economy leading the market. Therefore, the stock market rising can actually inspire better growth in the economy. And why might that be? Well, animal spirits. People are richer, therefore they're more free to go out and spend and be active economic agents, as they say. If a big chunk of their security and their net worth and their confidence lies in their stock portfolio, if because of, say, higher inflation and higher interest rates, a la the 30% drop during 2022, which those were the reasons for it, frankly, well, then that kind of decline in this kind of environment could sow the seeds of, and I'm going to say, a mild recession. And so, in a sense, I'm not saying we should be outright bearish. I think we should just continue to invest while hedging against some of these potential outcomes that the further we go, the more likely they look. Let's see, what else here would be worth sharing? I shared this on the written blog. This is kind of, as I said, the consumer is feeling the blue line, and that's the cumulative inflation since 2020, while Wall Street is celebrating the rate of change. If you can't afford a hamburger, for lack of a better example, because of all this, if it goes up by 2% and not 10%, really doesn't mean anything to you. The price of it that it's accumulated to is still killing you. And while when you look at the consumer in the aggregate, he and she look pretty healthy. When you separate them out by income category, not so much. Okay, so let's just go quickly through here. Looking at the technicals, the S&P 500, since we talked last, has broken down below this rising wedge pattern that I had to adjust a little bit. Pretty good trend line, broke below it, recaptured it, broke below it here. A lot of resistance as we bounce back up against that. Indeed, we do have a sell signal now on the MACD. We didn't the other day. That's when the red line crosses above or the white line crosses below. Still have these bearish divergences, still a very heavy look. You can see this green line has been pretty good support. We'll see next week. As I keep saying, though, seasonality is very strong right here. These technicals say we should be concerned. Seasonality says that we could very well have a nice Santa Claus rally. Again, that caveat, as I said earlier, being the Fed meeting potentially. The NASDAQ 100 ETF has broken down below the rising wedge pattern. Resistance right here at the previous all-time high, like really closed right on it today. And just battling with that 20-day moving average like it tends to. We had an island cluster, island reversal pattern right here that tends to play out a lot more than this, and you can see the market's trying to find its way back. Not a good look here on the daily chart in terms of momentum. The US dollar, wow, I really didn't think we were going to get this high, continues to go. Has been a headwind right in here for stocks. Certainly wasn't today. Right now, you can say you have kind of the makings, right, of a new flag pattern. I just don't think it goes that high. but the technicals, certainly we don't have a bearish divergence here. A little bit of one here, overbought. Dollar could give some way here going forward. That won't be bearish for equities. If we could get the dollar to sell off a bit between now and end of the year, that's going to be fuel for that Santa Claus rally, in my view. Gold, gold's trying to battle its way back. We talked about, what we did up in here. We hedged it, luckily right at the right time, got all our money back and some, rolled the hedge down. So we'll just sit on that. If gold does fall out of bed, if this is a bear flag pattern, would not surprise me. Between now and the end of the year, we're pretty well protected on our gold position with our hedge, but we can just let it run right now because essentially it's free for us. This is looking encouraging here on momentum picking up, obviously, because we've got this coming back, battling right now with its 50-day moving average. 10-year yields are key. It looks like here, right, that they've broken down below the uptrend line. That would be a sell signal on yields. Yields were up a little bit today, as you can see here. Bearish divergence. If yields do roll over, then that would be very bullish for the rally in equities as well, at least to the end of the year. And then I've been talking a lot about the go forward setup, and I'll really hit this in the year-end message, being really favorable for non-US over US. I've talked a lot about valuations. This is just the PE. I won't run through the charts in the interest of time, any more of these, but this is a historic canyon between Asia Pacific, Europe, and emerging markets. And so this is pretty compelling. One thing that analysis that we've done a lot over the years, spent a lot of time on, is the correlation between the dollar and global securities, everything, but in this case just equities. So let's go back to the 90s, and let me just make a point here. So when I go through the decade of the 90s, which we did really well in, I remember all this because I started in '84. It was a decade for U.S. stocks. The yellow line is the U.S. The orange line is emerging markets. The blue line is the EU. Don't have the data that far back. And the orange line is Asia Pacific. So, Japan, coming off of its 80s, phenomenon, actually lost money, 7% during the 90s. Emerging markets doubled in 10 years. U.S. stocks, tripled, of course. All the while, the dollar was stronger, right? And part of that could be rotation into U.S. equities, right? Foreign investors buying the dollar-denominated stocks would push the dollar up, right? But there's a long-term, there's a correlation between a rising dollar and rising stock prices, whether it's chicken or egg, or, whether, it's causation versus just correlation. Of course, we can have that debate. The tech bubble burst, and then by 2003, the market was bottoming in March, but I'll just go there to April. And by the end of 2007, it was topping. So let's just look at the relationship there. So this was an unusually good run for us because we almost always have some serious global exposure. So here's a period where the dollar trended lower, right? And the U.S. up 60%. But look at emerging markets. Emerging markets tripled. Asia Pacific was up 150%. Not so much for Europe. Europe just did a little bit better than the U.S. But again, particularly emerging markets, there is an absolute negative correlation between emerging markets and the U.S. dollar. So then we go to the bottom in '09 after the Great Crisis. And let's just go ahead and pull it all the way to today, 2024. And we've just had a massive rally in U.S. stocks. And we've had quite the rising trend in the dollar. So our view is that in that recession scenario, as it usually does, the dollar will rally if we do get a recession starting this next year. I think the yen will do better, and we do have a yen position, and we can have that conversation on another day as well. But just a massive, massive outperformance in the U.S. market here. Our long-term view, and I'm going to give you lots of texture or detail on this in our year-end letters coming up, is that the dollar will decline during the next cycle, right? We're still at the end of this cycle. And then we get that dollar decline, and we're going to look for significant outperformance of non-U.S. equities, and we'll be very selective in the areas or the regions that we invest in. And we'll still own U.S. stocks, of course, in the right sectors, but we do think the setup is unique, and it's also a very good setup for massively under-owned commodities as well. So we're excited about the next cycle, but we still got to live through the rest of this one. And uncertainty is the order of the day, and I do get it. There's some exciting new policies coming. There's some policies that the market's not too excited about, but at the end of the day, there's going to be the effort to throw more growth into this economy. As I said before, in 2016, this economy could absorb a lot of that. A little bit tougher today with these inflation levels that I just showed you and these valuation levels. So we have to be thoughtful and careful in this environment still. And I'll leave you with that. And just once again, it would make sense to me to see this thing melt up a bit more between now and the end of the year. And next year is going to be very interesting to navigate from an investor's perspective. Folks, hope you have the best of weekends. Appreciate you so much for hanging in there with these videos, and I'll talk to you next week. Take care. Bye-bye.